So let's cross live to Edinburgh now to get that perspective. Our Stuart Thomson, International Fixed Income Manager at Ignis Asset Management. Thank you very much for speaking to us. So would you buy Irish debt right now?
Not today, but we have no doubt that the issues will go well. It's an opportunity for fast money to cover their shorts at a reasonable price. But as institutional investors investing for the long term, we would avoid Irish debt at the moment.
How much appetite do you think we're likely to see in this bond sale for these bonds?
I think it'll be well covered. It's reasonable maturities. The market is short. It's an opportunity to cover. It should go OK. We should see spreads narrow in for 2 or 3 days before the widening resumes.
Where do you stand in general, Stuart, on the troubled Eurozone countries, not just Ireland but Greece and Spain as well?
Well, if the US is turning Japanese in terms of slow growth, then Europe is turning Vietnamese. The European Union has agreed not to let any country go. It's rather like the domino effect that America sought to avoid in Vietnam. But the problem is that it's likely to be as successful as the Vietnam War and cause a great deal of damage to the European economy in the process.
So will you remain underweight in these markets?
Yes, indeed. We will continue to remain underweight. We believe that spreads should continue to widen.
What about the austerity measures in Ireland? Will they be effective in restoring some confidence in the bond markets? We don't seem to have seen much evidence of that so far.
Well, this is a classic case of Keynes's famous warning never to cut the deficit in the middle of a slump. Particularly not with any freedom over monetary or foreign exchange policy. All it does is reduce nominal GDP and increase debt to GDP even further. So it is a very awkward situation for Ireland, the caught between the devil and the deep blue sea, really.
Interesting. You expect yields to continue widening. Germany's biggest bond deal has recently said that they think the worst is over for the region's most indebted nations. What do you make of that?
Well, there's always hope, but we see no sense of reality about the predicament that Europe faces. And until we do, I doubt that we'll see any narrowing of spreads.
Do we have to distinguish here between those troubled countries themselves, the unfortunate acronym that the PIGS? For example, Spain has seen reasonable demand for its bonds, hasn't it?
I think there is a distinction between the liquid pigs and the illiquid pigs. The smaller countries are seeing their spreads continue to widen. The larger countries are benefiting from some flows into the euro. And if investors are buying the euro, they're likely to buy the more liquid pigs to get the maximum yield advantage. But this requires the euro to continue to appreciate at levels which are already expensive.
So what do you want to see happen in Ireland, in the Eurozone, to address these long-term challenges?
Oh, I think we and the market would like to see the European Union step up. We need to see the European Stability Fund. We doubt that there is a solution otherwise. We need to see greater fiscal coordination within Europe in order to satisfy the flows into those smaller peripheral countries which are suffering a great deal.
OK, well, thank you very much. Good to get your thoughts. Stuart Thomson, International Fixed Income Fund Manager at Ignis Asset Management.